Okay, welcome back for the second instalment. So there's just been a reminder about the recording of the session. So there will be recordings made available once I've kind of got something organised. But this session now will be fully recorded live as well. So again, if you're just want to check on your mute button just to make sure you're not going to interrupt, that would be appreciated. We're now getting to the kind of final aspect in terms of the transactional impact of the pandemic on the accounts. Many companies, for maybe the first time in their lives, claimed government grants. I did. Obviously, a lot of people took the support measures which were available, and for the first time had to think, well, how should we be accounting for this? And there were various things like the furlough scheme or the job retention scheme. There were things like business rate reliefs, other grants which were available from local authorities, small business grants. Some of those seem to be paid without anyone even really feeling that they'd made any application. You don't recognise a grant, a government grant or a government support measure in your accounts until you've got reasonable insurance that it's going to be received. So there was quite a lot of debate about, when are these things going to be received? When should they be recognised? And also that you comply with the conditions. Now, I was doing a training session yesterday for some accountants, auditors, and they said, well, how are we meant to know? If we're doing the audit, how are we meant to know if the staff on furlough were doing any work? We don't know what they were doing with their laptops. We don't know if they actually came into the building. We would have to be there all day, every day. If you're claiming rate reliefs, did you qualify? The onus is really being pushed, as far as they're concerned, onto the management. All you can really do is remind them these were the conditions. And as I mentioned, my brother is self-employed, a carpenter. He's been entitled to receive the self-employed grants. And I know on all of those applications, HMRC obviously are really pushing to actually try and make sure that those grants were not being claimed fraudulently. But this is obviously likely to be an ongoing issue for some years, with once the post-pandemic results start coming through, to actually see if the money was claimed legitimately. We don't need to worry too much about the details at the bottom of this slide, what method of accounting you use, because the general treatment either way is generally considered to be the same, that you report the grant in the profit and loss account as income over the period to which it relates. So obviously, if you're receiving 80% furlough grants, if you're paying the wages and salaries at the full amount and you're receiving the grant, you would show the wages and salaries expense exactly the same as normal, and you would then show the grant receipt as income in the profit and loss account. The thing which has been made absolutely clear is you shouldn't net the one from the other. You can show the furlough grants separately, but you don't have to. So if some companies are showing on the P&L account, this is our furlough grant, if others are not, it doesn't necessarily mean that they haven't had any. It could just be reported as other income. So it is an area where there is the ability to be flexible. Some might want to actually make it clear that we were claiming all these grants. Some might view that it's a sensitive area. Looking at the other particular measures, obviously we've got the job retention scheme that I mentioned, which is still running on, and companies have been using and been helped by it, which obviously up to now has also had an impact on things like the going concern, because the staff are there, you've been able to retain them, which was exactly the point, so that when activity can more naturally increase again, you're ready and able to go. You don't have to find new staff. There are also various business interruption loan schemes targeted to many different companies. And I'm going to look in a bit more detail on those, because there are two issues, particularly in the way they're reported in the accounts, where there is no real consensus into how these things should be reported. And various liabilities, particularly VAT, could be deferred. However, the normal corporation tax payments could not be, with the corporation tax payments falling due 9 months after the year. So if you were having a really good financial period up until March 2020, but obviously all the negative has been during the pandemic since, even if you had a significant corporation tax liability which was due, that would still have to be paid. So there was the sense that there was the help with the VAT, but not with the whole position with taxation. Just to explain with these business support loans, and this is everything from those which were available for small and medium-sized companies. For very small companies, there were bounce back loans, and also they were often interest-free for the first year, and after the first year the interest would be at a discounted rate. So for example, a bounce back loan would have interest after the first year at 2.5%, whereas a normal business overdraft might be at around 10%. So these were good, cheap finance measures. Now, obviously, they were there to support businesses which need them. A friend of mine just up the road works for a construction and surveying company, and in his words to me, the loan saved the company. The fact that they could defer the VAT, the fact that they could borrow this cheap money, just about saved the company, because they were in quite desperate financial measures before. Even though they're in construction and those weren't related to the pandemic, these loans did basically help them. And another friend in a similar role with another construction company, you know, said the same. When this cheap money became available, his view was, why not claim as much as we can and then use it in the business? In the first case, maybe that is, again, masking what is a longer term going concern problem. But just because loans have been claimed doesn't necessarily mean that the company was in financial difficulty. A number of people took the view that, well, you know, this is available, we will take it, we will use it, we've got to pay it back. All we're getting is a lower rate of interest. So why would we not take this support? The two accounting issues are as follows, if I can just explain it. So let's say the repayment terms are typically between 3 to 6 years, although that for very small companies could be 10 years. You don't have to start at all making any payments until next year. You can take payment holidays. So if you've got a loan which maybe started last year in 2020, it didn't cost you a penny for the first year, and you're going to now repay it at this preferential rate, maybe over the next 9, 10 years. And the loan is effectively guaranteed to the bank by the government. The two accounting issues, and these are quite, well, one of them I think is easier than the other, but they are quite complicated. The fact that the government provided the bank with the finance for the first year, and the fact that the government said, look, don't worry, for the first year, we will compensate you for making this loan. So the business client doesn't have to pay the interest. The government will pay it. That then raises the question whether the government covering the interest was a government grant. In which case, what you would do is you would show the interest, the arrangement fees as an expense, and you would show the government grant as being further grant income. That is one option. The alternative is that actually this is nothing to do with the borrower. That is an arrangement between the bank and the government. You're getting funds which are interest-free, so therefore for you, there is no income and there is no grant. There is no expense, there is no income, there is no grant. Now, sadly, the only way to really check what is the correct accounting treatment is to look at the nature of the loan agreement. And all of the banks who provided these, they would get their lawyers onto it and they would draft their own type of loan agreement. In some cases, it might have been organised so the bank would charge their customer and you would then recover it as the bank from the government, which would give you this treatment. Other banks, and the one I've looked at for my loan, basically just said, as far as we're concerned, we're not charging you a penny. So for mine, it is not a grant. Now that's the first issue. The second issue, and this is something which accountants, again, have been struggling with for 5 years. If you're getting any kind of financial support, you need to ask the question, for this loan, which is at 0%, and then it is at 2.5%, is that a commercial rate of interest? And if it is not a commercial rate of interest, is this effectively almost like a form of additional interest-free equity finance being provided to the company? It's what we would call a financing arrangement. If it is a financing arrangement, what it essentially means is that that 2.5% is not the reality. The reality is part of this money you've claimed, 50,000, 10 million, 45 million, part of it is effectively a kind of equity contribution to the company, which should go under shareholders' funds. But the rest of it is a loan, and potentially that loan should be at your normal commercial rate of interest, which might be something like 10%. So you might say for a bounce back loan, 10,000 of it was basically just free money given to the company, but 40,000 is really a commercial loan, and the interest on the commercial loan is 10%. Now, many accountants would argue this is making the accounts pointlessly complicated. This is overcomplicating it so that no one understands it. But unfortunately, there is no agreement what is, in the case of these loans, what is the correct treatment. My own personal view is that as these loans were available at cheap rate to everybody, for these loans with the government security behind them, the commercial rate was 2.5%. But my view would be that is a commercial rate, and therefore what you would do is you would just show it as a loan in full, which was interest-free for a year, and then we'll have interest applied at 2.5% for the remainder of its life. But others might take a different view, and others might take a different treatment of it. That is probably one of the more kind of specific kind of contentious areas around this. And unfortunately, I've seen kind of comment from ICAW who have, said, well, really, you need to take a view as far as you are as a company, what you think works best. I think if you make it clear you've taken the loan, if it's clear what the security is, if it's clear what the terms and conditions are, and also if you put this into the context of your broader disclosures in terms of how does this help with the business future plans, the going concern, that does make sense to just keep it simple. There's only two real other specific issues around the kind of support measures. With the VAT deferral, obviously, normally for most companies, VAT is due within 1 month. So the amount you would have on your balance sheet for VAT would normally be the amount which is due for the most recent quarter at most. If your VAT quarter aligns with your year end, you would have maybe 1 quarter's VAT at most. If only the VAT quarter doesn't align with the year end, you might only have a proportion of the VAT. What was introduced on the pandemic was that the amount of VAT due for March, April year ends, May year ends was allowed to be deferred through to March of this year. And then what it was announced when you got to March of this year, starting in February of this year, you could pay it in installments. So my accounting year end is the 30th of April. And so when I got to 30th of April last year, I didn't pay the VAT because, you know, everything was completely in a state of confusion. The view was the government is giving me this opportunity, I am going to take it. So we were maybe obviously sensible. We put the money in a separate deposit account and said, well, we'll keep it on deposit until it becomes payable. But obviously that means we not only had our April VAT due, but it wasn't then, as we realized, it wasn't actually going to be paid in full. And we've decided to take the installment plan because it's interest free. So it means for the first time, the VAT is going to be a creditor in part due in more than 1 year. Which obviously changes the presentation, but it also changes the numbers on the balance sheet. And it is a tricky judgment. Has the company used these support measures because it's just good, sensible financial management? Or is it actually these support measures which are keeping the company alive? And I think we'd all acknowledge until the support measures are withdrawn, we don't know. And you could say until, you know, interest rates go up, we don't really know to what extent this is you know, keeping companies afloat. And then the final one was on the business rate relief, where you were entitled to a business holiday, business rates holiday in certain sectors, businesses of certain size. I mean, what that meant was just actually for a period of time, there was no expense. So the expenses would be falling. Obviously, it raises the question, what do you expect the expenses to go back up to? If we're taking the kind of more forward-looking role, where do we expect the expenses to be when we're back more to normal? So actually, I mean, there are the specific issues around the various measures which are new transaction types, but that is just part of a whole kind of wider impact. It would be very unusual to see that the accounts going through the pandemic do not look very, very different. If you've claimed a bounce back loan, but you've just kept it in case you need it, depending on how long this goes on, you might have, you know, huge amounts of cash, a huge liability, but the underlying reason behind it is actually very logical. So what that brings us to, and I don't know, you know, to what extent this would be something you get involved with. It is something which frustrates me, is that sometimes you have to look behind the numbers to get to the reality. And so what I want to just go through now are the presentation and disclosure issues, the specific issues which relate to COVID. The other thing you've got to bear in mind is that we were already dealing with two issues. The first issue is the approach to presenting accounts has been for 15 years, since we brought in the Companies Act 06, that what you're required to do is think small first. So you think what would be appropriate disclosures for a very smallest entity. And the smallest entities are defined as micro entities. And that is essentially an entity which generates less than €1 million a year in revenue, has fewer than 10 employees. So it is a typical kind of small family, husband and wife company, that kind of thing. You think what would be appropriate for a micro entity. The next level up are small companies which can be anything of turnover up to £10 million, then are also required to disclose more information, but it is still significantly lower than anyone above them. Once you are no longer a small company, if you're medium-sized, then much more information has to be provided, and you're normally then looking at a more full set of accounts. The other thing as well, if you're more used to dealing with small companies, is what they file at Companies House can be filleted. And notably, they don't have to file a profit and loss account, as you may well be aware. We are questioning whether we've gone too far. I don't know if any of you ever have to look at micro entity accounts. If you ever look at accounts of very, very small businesses. And these would be businesses describing themselves as micro entities. Yeah, this is what I was starting to gauge. I mean, if you are largely dealing with micro entities, the accounts, the actual required accounts tell you virtually nothing. And even a small company, you'll get, if you get the full accounts, not the ones on Companies House, you will get the profit and loss account. You will get the balance sheet. There might be a few notes to the accounts, but the notes to the accounts are really the bare minimum. Hang on again, can you check you're muted?
You've added on 4 hours for Joe's. Is that to be added?
So I'll just try and find who's talking and I'll try and get them muted. Bear with me a sec.
Is the right on there then? I'm not.
No, sorry.
If anyone recognises the voice, let me know.
The date right on there, the date, sorry, because the 4-hour one was from last 4 weeks.
15 to 20 seconds.
The right one there. That's why I deleted it too.
Just a second, yeah. Well, the date seems right, 15, 20 seconds, 29. It's right at the end, you know, where you've got totals, you see.
Oh, okay, apologies. Yeah, no. Can you take those off there?
Sorry about that. Obviously, it does occasionally happen that we have this. It's a new kind of realities. I've had worse actually in conference rooms. I was doing one conference up in Glasgow once in a hotel, trying to keep everyone's full attention. It was alongside the Clyde, and it was only about halfway through I realized everyone wasn't looking at me, they weren't looking at my PowerPoints, they weren't getting very excited about UK accounting. They were looking at the fact that the police were dragging a body out of the Clyde behind me, which obviously is somewhat distracting. and it's easy to lose the flow. Yeah, it's a different set of challenges we now have, but they all could be overcome. So I was just talking about the fact that we have this sense that micro entities don't really give you very much information at all. And equally, all of the kind of detail about the balance sheet, sometimes people will provide it as additional supporting management information, but that is often, you know, strictly on a do you need to know this. But I do find many times that I'm having to provide that information just so that people can really make sense of what's happening. So we are asking that whether we've gone too far. With larger companies, which you might not be looking at as often, there is a lot of now narrative information which is being provided. And it does seem to be the case that we keep adding more and more to the requirements. So there's things like there's got to be a director's report, there's got to be a strategic report, there's got to be a report on your compliance with section 172 of the Companies Act, which is about corporate governance. There's got to be reports about your environmental activities for climate change. And it does seem that no one's actually stopped and thinking, hang on, we need to have some kind of edit function. Someone needs to make sure that this is actually telling the story. And I do think with small companies and medium-sized companies, there is still the position of people having the position of saying, I'm going to say as little as possible. Whereas I would say for this, my recommendation would be, if in doubt, rather than leave it out, if you're not sure, then maybe say more, give some more information about this. So a micro entity doesn't have to produce a director's report. It doesn't have to show anything other than a P&L and a balance sheet. It doesn't even have to show any notes to the accounts. The only kind of disclosures would be, have they lent money to the directors? Are there any directors' loans? Are there any off-balance sheet arrangements that you really need to know about? Are there any other business they're connected with? How many employees have they got? Which are the bare minimum disclosures, really, for creditor protection. Small companies do show a bit more. They do show accounting policies, and they do provide you with a bit more detail about things like what's on the balance sheet in terms of the long-term fixed assets. You know, a lot of the notes will give you more of a kind of feel of what is happening, particularly what is happening on the balance sheet, but you're still not going to get the full explanations. In terms of COVID relating to this, micro entities, there are no specific disclosure requirements at all. And all the guidance says is consider if additional disclosures are needed. So for example, if you have claimed a full bounce back loan, so you've got this huge long-term liability, given the reaction of some lenders to seeing that, I think it is perfectly sensible to just provide some kind of explanation that this is a bounce back loan and what you've done with the money. If it's basically securing an emergency fund to provide you with kind of working capital for the foreseeable future free of charge, which hasn't had to come from you as owners, then that is perfectly sensible. If you do want to provide additional principles, you would follow what would normally be done for a small company. Now, with a small company, which is the next level up, if you have any areas which are areas of specific management judgment, if there are areas where there is a real subjectivity, you do not need to say anything in the accounts, but all the regulators recommend it. And actually the recommendation is, if you want accounts to be considered true and fair, if you want accounts to be considered fully in compliance with the law, then you should probably explain what you've been doing. So I would expect on things like taking government support measures, and certainly I would expect around things like going concern, if there was significant uncertainties, that there would be some kind of explanation. There is no real guidance where you would include that, but the normal accounting treatment is that after the accounting policies, so you get the accounts, you get the accounting policies, after that you have a section for management judgments and estimation uncertainties. That is the normal disclosure. So as that is normal good practice, I would expect that is where these things would be disclosed. And certainly I would be recommending people to actually set it out. And equally, if you've had a really, if the pandemic hasn't been that bad for you. Now, I mean, I'm really lucky. I haven't really been that ill at all for 18 months. I've hardly had a cold, maybe because I've not been going anywhere. I do live around London. I did some training last March for a firm, and a large number of people had just come back from China. I then went to a football match shortly afterwards, which was the Manchester Derby, which was just before the Cheltenham Festival, which were considered super spreader events. But I've been really lucky. I've not really been ill, and I've not really had any symptoms. So I don't know if I've had the disease or not. Equally, the virus. Equally, my business, you know, initially it was a real panic because all of my training was cancelled. I don't want this all to be about me, but, you know, a lot of people I spoke to, they said, yeah, you know, there was an initial feeling of, oh, how's this going to work? But then actually, a lot of businesses, apart from really a lot of hospitality, could start returning to quite good levels of work. Other areas like food production, manufacturing, a friend of mine works in a warehouse, they're still on reduced working because of the shift patterns. They can't get everybody in. Another friend of mine works in a cinema, and again, they've got teams in bubbles, which means for many months they couldn't operate in full. There is no kind of one size fits all response to this. And I think there is a sense of, you know, maybe just explaining what have been the real impacts, what changes it had, and just to actually be a bit more honest and revealing. And that is where we're heading with accounts, and certainly trying to encourage people to break away from pro forma boilerplate and just say a bit more. If you are anything other than a small company, you do have to disclose significant uncertainties. You do have to disclose anything around your going concern status, which is likely to be critical. The other thing about going concern, I mean, obviously a lot of companies have to stop trading because they're just insolvent. You know, eventually the penny drops. We've got to, you know, they've taken decent advice and someone has said, you know, just give up. It's never going to work. But a lot of companies actually come to the end of the road. A lot of companies might think, well, you know, that's what we plan to do. We've done it. The company is not really needed anymore. It was for a particular project. It was for a particular activity. It was for that time in my life. I don't need it. And I'm actually going to allow it now to be wound up and dissolved. Well, once you've made that decision, the company is not a going concern. So it shouldn't be presenting itself as a going concern. If there are those planned cessations of a business, well, you should tell people. Now, this is all the stuff where sometimes the accounts are very, very good at telling you lots and lots of facts, but they kind of avoid the main ones, which I would say is the who, why, where, what, and when. You know, who are we? What are we trying to achieve? How do we make money? How are we financed? Who do we supply to? Why do our products get sold? A lot of that seems to get missed. It is not at the moment compulsory until you get to medium-sized companies. And in the medium-sized company and anything above, you will get a much more meaningful directors and strategic report. Now, when I say meaningful, it should be meaningful. Often these are written with no real sense other than we've complied with what we needed to do. Small companies, again, the director's report is very, very limited. It basically tells you nothing. You might want to include optional disclosures, and you might want to consider things like what you've done to consider the needs of your youth, but it's optional. And I do accept lots of companies will only supply that information on request. And I think for things like lending applications, for things like credit assessment, what they're actually doing is maybe creating difficulties, because if they did address those issues earlier, it might mean it kind of gives them a better result. Strategic reports should report principal risks, uncertainties, future developments. They should also talk about your performance. Two things about anything, if you're looking at a strategic report, it should cover both the positive and the negative. So the strategic report should not just be seen as a kind of marketing, and it should be balanced. And I think I did read somewhere that it's you know, Elon Musk's, is his first question when looking at anyone to come and join in business, what are your weaknesses? And if you say you haven't got any weaknesses, then obviously that is a weakness, because you're delusional. You will not be perfect at everything, and if you believe you're perfect at everything, that's his answer. But then it's how can you present this without it doing huge damage to your business? And I think you've got to mention it, but it should be put in terms of, if you believe you're still a viable going concern, why is that? The other side of it as well, in terms of the disclosures, is that they should cover the three main aspects of your performance. And many business owners only think in terms of profit and loss. Many business owners, it's all about their turnover, it's all about their profit, it's all about how much they can earn from the business. When it comes to the balance sheet, you know, they kind of know, if they've been properly explained to, that the balance sheet doesn't tell them how much their shares in the company are worth, that the balance sheet is not designed to give you a sense of value. And they know that it is there for creditor protection, hopefully, if they've had that explained to them, which is why, if anything, the assets will be undervalued. And it means the liabilities will include provisions for probable liabilities and will be overvalued. So they will appreciate, you know, that is why intangible assets are not generally on the balance sheet, even though that might be the only real asset the business holds. I mean, certainly in my business, anyone in kind of accountancy, legal services, professional services, the main asset you've got are your precedents, your intellectual property, your know-how, and none of that is on the balance sheet. But therefore, if the balance sheet is about solvency and liquidity, that should be talked about. What are the principal risks? What are the uncertainties? What are you going to do about it? obviously I talk to so many people and say, yeah, you know, I know there's a negative balance sheet. I know they've got net current liabilities. I know they haven't really got any assets, but I know the owner is really wealthy and he's going to support the business for as long as it takes. And you think, well, you should just say that. Now, I can understand why some companies don't. I must confess, I did look recently at the accounts of Manchester City, which obviously a very large company, but they're in the same situation. They are dependent on the continued financial support of the owners. If you look at the accounts, something like 60% of the revenue is sponsorship from companies owned by the owners. Now, I had to kind of presume that because 60% of their revenue is described as other. And if I see a big number in the accounts, which is described as other, I'm on the same page as HMRC, that I think that you're trying to hide something. And there was no mention of sponsorship anywhere else. They talked about broadcasting income, merchandising, stadium income, no mention of sponsorship. Also, the owners have put in over £700 million of equity. Now, that is why it is considered to be a going concern. And many companies are in that position. And many owners obviously see a blur between the business finances and their own. But as long as they're prepared to stand behind the business, then that can make the business a going concern. But through the pandemic, that might have had to have been explained. Okay, I'm mentioning a bit about this because there is a huge project at the moment to try and increase the disclosures with too much focus just on numbers and trying to make it a lot more balanced. Forward-looking judgments, a really good example that I saw on this was from the accounts of Whitbread PLC. Again, I know it's a listed company, but in their accounts last year, because their main business now is Premier Inn, they're largely now morphing into a hotel group. The disclosures really set out very, very clearly all of the kind of support measures which were around, what they were doing. It was specific to their business, and it did explain their key assumptions. So that goes back to my question from earlier. When do you think the pandemic is going to be over? Who knows? Clearly, no one. So therefore, all you can really do is say, well, if we work on the basis that we'll be at 60% capacity by the end of the year, that we'll be at 80% capacity by halfway through 2022, and we think we'll be back to full capacity by the end of next year. State your assumptions and people can agree or disagree. There is more guidance on these judgments, estimates, and it gives you some headings that you should refer to. But I do appreciate from what you've just said, this is only really larger companies. Any ideas? What is the accountant's favourite measure of profit? Any ideas which measure of profit an accountant would say is the most accurate measure of the performance of the business? I haven't got a poll, but I could give you some options. Is it the gross profit? The profit before tax? The profit before interest and tax? Or the profit for the year? Any ideas which one would accountants say is the best measure of profit out of those four? You can answer privately if you'd rather keep it to yourself. Is it gross, profit before interest and tax, profit before tax, or the profit for the year? Okay, we've just had a good. We've had two options, which are two different options. I am going to go with the second one. The accountant's favourite measure of profit is normally what we would refer to as operating profit. And the operating profit, by definition, is the profit before you've deducted interest payments on loans and before you've deducted tax. This, we would say, so thank you very much, is the most reliable measure of profit. For good reason. I mean, the interest payments are really just a factor of whether you've decided to fund your business by borrowing the money. And the tax payment is a symptom of what is the rate of tax, which country is it considered you earn your profits in. These are not things you can fully control. What you can control is your revenue, your trading expenses, whether they are direct cost of sales or whether they are the optional overheads. If an accountant says an exceptional item, any ideas? An exceptional item meaning? What do we mean by an exceptional item? Any ideas? Okay, the clue is maybe a bit later on, because an exceptional item is either income or expense, which is either unusual because of its size, its value, or because of the nature of the event. And the general kind of thinking behind describing something as exceptional is you're really saying, people, don't worry, this will never happen again. The profit before interest and tax should be calculated after exceptional items. So even if there is an exceptional item, you should calculate the profit saying after we've deducted this. But what you might see companies do is they prepare a set of accounts with the profit before the exceptional item and then after the exceptional item. And what the company might be using are what are called alternative business methods or alternative valuation methods. There is a refinement on PBIT, which, if we say what we call profit, the Americans call earnings. Obviously, one of the main measures which a lot of people in corporate finance will use to measure the profit is, rather than PBIT or EBIT, they will use EBITDA. And almost immediately, I also heard people taking this one stage further and saying what we really should be looking at is EBITDA. The D and the A stand for depreciation and amortization, with the argument that often those bear no resemblance to any loss of value. If we're depreciating our assets, those assets could be going up in value. And therefore, although we're required to depreciate them, it is a non-expense. If we have intangible assets which we've bought, if we bought an intangible asset from a third party, we are required to amortize it, even if it is going up in value. But what was argued is you can go one stage further, and all the costs relating to COVID could also be treated as not recurring true expenses. And we could calculate this alternative performance measure using COVID as an exceptional item. The only thing he's saying is, well, first, if it is going to be treated as exceptional, it must just be those costs which are additional and are specifically related to COVID. So if these are employees you would have been employing anyway, you can't now claim that all the employment costs are only being incurred because of COVID. If these are buildings that you would have been renting anyway, you can't just say that all of that business rent is because of COVID. If you've put in things like perspex screens, if you've given a grant to your employees so they can work from home, so they can have a decent chair or whatever, those can be specific COVID related costs. If you've needed extra staffing because of you needed more people because you've got to work in teams, or because demand has gone up, if you're a delivery company, for example. And if through that demand your turnover has gone up, the turnover should be described as exceptional as well. You can't just have all the costs and say, don't worry about these, but then all of the kind of benefit is then just claimed as part of your normal business. Okay, that is some of the guidance on COVID. I wouldn't expect everyone to just put everything down as huge exceptional items. There might be some being reported, and obviously you need to consider. Do you expect the pandemic to be a one-off? Do you expect to experience anything like this again? Yeah. And I think that word, Natalie, says it all, hopefully, because I think we're aware in certain parts of the world where they've had the swine flus and the bird flus before, they are not so relaxed about it as being the kind of, well, it's been a weird 18 months, but you know, it'll all be sorted out by the end of it. Okay, there are a few more issues. Thank you very much for your time and patience. There's a few more things I will go through, then I will deal with any other specific questions you might have, and we'll stop the presentation if you do have questions. Just in terms of more practicalities, and there is one really big issue here. First, in terms of what the Companies House did almost immediately when working from home became legally compulsory for most people, is they extended filing deadlines. Initially, you had to claim, but then eventually it was granted automatically. And the normal deadline for 9 months was extended to 12 months. I do know that obviously some people will always push things to the limit, because, you know, if they don't have to get it done until 12 months time, well, they'll leave it to 11 months and 30 days. And I do know most credit rating agents work on the basis that if you are not completely up to date with filing your accounts and all the other relevant information, that should always be seen as a negative. So some concession was granted, but I do agree that there is normally never ever a good reason to be late filing your accounts. A few years ago, I can remember it was very notable, Gordon Ramsay with his hotel group was late filing his accounts, and the credit rating agencies scored him down, saying you're late, you know, there's missing information. And there was an explosion of 4-letter words and kind of, how dare you, don't you know who I am? And then shortly after that, a lot of his restaurants, some of the big chains he'd set up, started closing down. He'd overextended. leaving the rating agents to say, well, you know, we told you so. There is never a good reason for this. Although I better be honest here, 3 years ago, we were late filing our accounts. We just completely forgot. We had to submit the tax accounts in the October. We had to submit other tax returns in October. When it came around to the January, we just completely forgot. Now, we were on a beach in Mexico enjoying a very nice margarita, and that is the only thing I would ever accept as a good excuse. And the thought of being able to go back there, I still think would be a good excuse, but I do know it could have huge negative connotations. Larger companies were given more concessions, and it was things like, in order to have various meetings, the articles could be more easily suspended in terms of what was an appropriate meeting for making decisions. You could hold a closed AGM on telephone or Zoom, but there was a real reluctance to have full virtual annual general meetings for the larger companies that need it, because there is plenty of protection already for things like shareholders to vote by proxy if they can't make it to the meeting, and that was seen as being the appropriate solution. Okay, now I hope you have got some stamina still left, some enthusiasm, because the next issue, as far as a lot of regulators are concerned, is one of the biggest issues as we go through this whole period, keeping in mind the timescale. And I'm going to ask you just one last question. So I do hope one of you will feel so inclined to join in. In order to pay a dividend, what must the company have? What is the most essential thing a company must have if it is to pay a dividend? Good, thank you, Mike. You've got to have, as described by law, you have got to have distributable profits, which basically means that you've got accumulated realized profits, which are in excess of any realized losses and also in excess of anything that you've ever previously paid out as dividends. You could have all of the distributable profit in the world, but you still wouldn't be able to pay a dividend. There is something more fundamental that you need. Any ideas? Good. You need to have free surplus cash. If you do not have free surplus cash, you can't pay a dividend. And this is the issue which has been one of the most contentious. When we hit the pandemic, March of last year, what are you going to do about your normal dividend payments? It's all very well if you're producing your accounts to December 2019, because the accounts to December 2019 could have considerable reserves, but you should only pay those reserves if it is not going to lead to financial problems in the future. The two things that you need to make sure is that you've considered your specific capital maintenance obligations under the Companies Act, but also under Section 712 of the Companies Act, all company directors must act in the fiduciary best interests of the company and all its stakeholders for the long term. And if you are carrying on paying dividends, knowing you are about to head into much more challenging much more challenging economic conditions, then you are not complying with Section 172. Now, obviously, none of this matters unless you fall into financial difficulty. And if you pay the dividend and it means you've got, even if you've got negative reserves, if the cash flow is still there, if the business is still viable, then no one gets affected. I mean, although it is illegal, the only kind of possible claim could be if a creditor felt that they hadn't been paid in full as a consequence. But obviously, a good example of this is what happened within BHS. The company was heading into very difficult retail market circumstances. The company didn't own any of its assets, none of its shops. Its shops had all been sold to private equity funds who were going to be just charging a commercial rate, come what may. But the company was still paying to its owners significant dividends. Now, at the time, they had the reserves, but you know, just around the corner, you might not have those reserves. The other issue as well is if you're going to be paying a dividend, I know these are kind of forensic issues, but if you're going to be paying an interim dividend in the middle of the year, it should be supported by management information. You should have interim accounts which show you still had the profit. So if you're getting to pay the dividend for December in July, you should still be able to show that you've got the profits available to support that dividend. Now, I know sensible companies will have done this. One of my clients, they normally take a very big dividend. This year, they've decided they're just going to have to go without because of that uncertainty. But obviously, a number of companies are not as cautious. Okay, last couple of issues for you all this morning. The accounting systems that produce the accounting information will have changed over the last 12 months, 18 months. And if we look at a company with a year end 31 December, it is possible in that year they were operating different systems at different times of year. And they would have probably had one system up until lockdown in March. When we were going through the worst of lockdown up to the summer, it was probably the most challenging. And then as we went through into the autumn, it became a different form of challenging. And all the time the systems would have been evolving. If you were largely working online and paperless, it might not have had much impact, but still the controls around that, who authorizes payments, who authorizes contract terms, who approves receipt of goods and services, it would have been different. And obviously that does create risk in terms of how reliable are the numbers. And obviously that is another consideration. And then finally, if you are a larger listed company, under the current corporate governance, you are required to make a positive statement as to your ability to survive, and you get the full weight of the corporate governance code being applied to you. But as I've gathered, as we've gone through this morning, that is probably away from the majority of your thoughts and concerns when we're looking at the kind of more owner managed businesses and how they have worked and produced through things. That pretty much covers, to an extent, all of the issues that people have been thinking about dealing with over the last 18 months. I really did think by now that we would be looking the other side of it. And I think there is this kind of this growing fatigue in terms of, you know, for how much longer are we going to have to be working through these things? Certainly for 2021, 2022 year ends, it's still going to be an issue for us all. But other than that, thank you very much for joining. Hopefully that was helpful, useful, relevant. If you've got any other questions, please feel free to ask. You can put them in the chat box. You can unmute. I am going to take down the slides now, and we'll try and make available copies of everything in due course. But if you have got any questions, please feel free to ask. Otherwise, best of luck with all of this and with wherever life takes you over the next few months. And I do hope you stay safe and well. Okay, I will stay online until you've left, but if you would like to go about your Friday now, I fully appreciate that. Okay, thanks very much.
Bye, David.
Thank you.